The Fed just announced a 50 basis point hike, which brings rates to the highest since 2007. So today we're going to talk about this and the implications, inflation data, the cooling economy, and what it means for your pocketbook. Hi, and welcome to Stop Being Sold. My name is Michelle, and I'm here with Brian. And so, Brian, let's talk about all this. Let's start with what Chairman Powell just said.
Yeah. Yeah, Michelle, when Jerome Powell started his press conference with an apology,
Yeah.
the market just like, really? And I'm sitting here cringing as he's saying it. First, I'm apologizing that we're doing this. I know it's bad on you. The economy's bad, and I'm hurting your pocketbooks, this, that, and the other. So you kind of knew in the direction they was going, and according to Powell, they're going to keep going. We kind of knew that they were going to keep going. And so just remember this, it's going to be higher rates for longer, it sounds like. So
Yeah, it's interesting. For the actual announcement, I was watching just some commentary, and there was and I'm sorry, I don't remember his name, but there was a gentleman on there, and he was talking about, he's like, they're not going to stop. And watching the what do you call them? The people that running the show there, the
economists.
Thank you. The journalists.
Yeah.
Faces. We're just like, wait, what? Really? Do you think so? And yeah, it really seems like, what they say, 2005, they're going to go for another few years on this.
Yeah, 2025, the chart that just came up on the screen. So that chart came up on the screen for everyone to see what he was going to speak about. He was talking 2024 and then 2025. We should be back to their 2% inflation rate is where a good where their target rate was for the long haul. So
right,
always has been.
So, and by the way, I didn't mean to say 2005. I don't know what year I'm in. 2025.
2025. It's all right.
So, what is interesting is that they're considering doing this for longer. Yet, well, here's the thing. I want to talk a little bit about the CPI numbers that just came out for November.
Yeah,
inflation. I'm sorry.
Yeah, good, definitely.
Yeah, because inflation numbers for November are lower than expected, 7.1% annually in November, down from 7.7 in October. So we aren't where we need to get yet, but we're starting to see this rollover. Food is still relatively high, but it appears it's peaked and maybe headed down. And then you look at shelter costs, known as the, OER, the owner's equivalent rent, which makes up a third of the CPI, and it's pretty hot at 8.8%. But if you look at the trend, you look at the charts, it appears that we may be peaking. And when this heads down, I would think that we would see the overall CPI drop significantly because it is a third of it. And then you have these companies laying off, although according to the Fed, the labor market is still too tight. All signs are pointing to a slowing economy. So do you think that they're going to send us into a recession, a deep one?
Oof. Well, here's the scenario. First, let's talk about the labor market.
Okay.
Powell commented on this, saying the inflation data shows a welcome reduction, which we was talking about in the CPI numbers the last 2 months, right? Yes. But he also stated that the labor market's still out of balance. And what he means by that is wages are still rising,
high,
which could also fuel inflation, okay? Sure. And unemployment's near decade lows. But you mentioned we're starting to see some layoff numbers, and a lot in the tech space, of course. They're cutting back expenses. And so you're starting to see some layoffs coming. But inflation risk, according to Powell, are still weighted to the upside.
Do you think that they're holding on to this 2 to 2.5%, goal, right? Do you think it's reasonable considering the world we live in right now? It's not the same world it was.
It's not the same.
Pre-2020. Do you think it's reasonable, or do you think that it's more reasonable to look? I'll just let you answer.
I would say, you bring up a great point there, because 2.5%, that target range has been a target range for decades.
Right.
Do you think we're in a different economy now? Yeah, we are. And again, we're in a different economy that just came out of a 2-year shutdown from the pandemic. And no one's experienced this before. Yeah. Okay. So this is a whole different ball game. Why not, in my opinion, why not take it a little slower? Let's do your 50 basis points today, as was expected. And let's sit back and see how this has worked, because what you've done already, based on your CPI numbers that you just gave there a few minutes ago for October and November, we're starting to see a slowdown. But we're also starting to see peak numbers in a lot of like the commodities.
Right.
Gas today, Michelle, here in Texas was $2.49.
Yeah. It's going
249.
down. Yeah.
Okay, we're starting to see a pullback here. So that's a good thing. So
All right. Do you think that they can go too far and cause
yes,
deflation?
yes, they can definitely go too far because again, and that's what the fear on Wall Street is right now. Are they going to go too far? Very good possibility they could go too far and drive us into a deep recession. That's and but here's the opportunistic side of this. Okay. When everyone on Wall Street is saying we're going into a recession, every bank CEO in the last
Yeah.
2 weeks has come out and said recession,
Yeah.
recession,
Outlook for
recession.
2023 does not look
Yeah.
good. Right.
Well,
Right.
when everyone's saying it, kind of go against them and say, you know what, I'm a little more optimistic than that because as I'm still traveling with work and everything, I'm still seeing a strong economy where I go. Rents, rental cars are still high priced. Airplane tickets are higher than I paid in the last 2 years.
Sure. Sure.
So I mean, it's everything's still up. Restaurants are still full. So the economy's still humming along, which could be a negative for rising rates because they may force us to stay in this position for a longer rate of time. So,
Great. Okay, so I want to actually talk about, you mentioned opportunity here. Let's
right,
talk about the opportunity to the consumer. So this is what I see, and I wish I could see the future, people. I wish I could, but I can't. What I see right now is that we're having higher rates, which means, it can be more difficult to get the home you want, or
right,
pay or afford it at that. You've got inflation that, like we said, it's coming down, but it's still at pretty high levels. It's
right,
almost a recipe for it. It's a lot. It's squeezing. My mom always said you can't squeeze blood out of a turnip, right?
right.
Eventually, you know, what do you, I guess, what is the real opportunity here for consumers as you've got rates rising here? So you've got mortgage, you've got, rates on credit cards, etc. And then on this side, inflation, yeah, gas is coming down, things like that. But CPI data is still showing it's not down here where it needs to be.
Yeah, that's true. That's true. But here's some good signs. Okay, number one, our savers are finally being rewarded. Okay, fabulous rates they're starting to get now. High yield savings accounts, online high yield savings accounts, 4.25%, 4.5%. That's
Sure.
good to see for savings rates. Finally, then people are being rewarded, and it helps alleviate some of the high costs that they're also getting right now. Okay,
Right.
so that's one thing. Second is so next year may be a pretty volatile year, kind of like the markets. They're going to stick to every headline, every CPI number, every PPI number,
Yeah.
every labor and jobs report that comes
Sure.
out on the Fridays coming up. You're going to see volatility spiking all around each one of them, big announcements, because we're going to be glued to, oh my gosh, can I hear, like today, all they wanted to hear was a pivot by the Fed
Right.
to go like pull back a little bit. Well, guess what? That didn't happen. They actually were more hawkish today than everyone
Right.
was
Right.
thinking. And then also some of the other Fed members were talking higher rates than were even
Yeah.
anticipated from every economist. So there's why when that chart came out showing that they may push this to 2025,
Yeah.
we could have some issues here. So
Absolutely. All right. I want to talk a little bit about opportunity in the market. Now, we don't give financial advice on this channel, but I want to know your opinion. Do you think that there's opportunity in the market with it being so volatile?
sure, sure. And here's why.
If you're not a day
Um,
trader, let me preface that. We're not
there
talking
you
day
go.
trading here. We're talking for average investors looking to, make a better return than 3% on your money.
Sure, sure. If you're looking to, if you got a 5-year high time frame horizon,
Right.
now's a good time to start dipping into the market.
Okay.
Okay. If you've got a 5 to 10 year time frame, definitely add to your portfolio or start
Right.
building a portfolio. If you're looking 10 plus years out, yes, definitely. My my opinion on that would be, if you're more than 10 years out, if you've got funds sitting in cash reserves right now, why not step in and buy on down days when you see the market? I mean, it was up 400 points this morning, the Dow was, and now we're down 250.
Sure.
Why wouldn't you step in and buy a little bit today?
Okay.
Especially good brand name companies, the Dow and the S&P 500,
Sure.
good quality names that don't have a boatload of debt attached to
Sure.
them,
Right.
and that their revenues aren't shrinking. Delta Airlines this morning just came out and said they're going to be the highest airline profits in their history for next year. Is that a good one to step in and buy? I'm not too sure, because I think the market already predicted that they were going higher. So, but they could be a great long-term bet. I mean, that's just, that's the things you want to look for now when companies are coming out saying that, look, things are good for us and we
Right.
think we'll be okay. But remember, travel could be hit very quickly
Sure.
on a massive recession if the Fed goes too far here. So,
Okay. All right. Well, good conversation. I appreciate it. And we'll see what happens. I mean, like I
yeah,
said, none of us can
sure.
see the future, unfortunately, but we can look at the trends and also watch the data and make decisions from there.
Yep, definitely.
That's about it. So what we're going to do is we're going to put a link in the description below and in the pinned comment. And it's a video we did on best places to stash cash right now.
Oh yeah.
So
Totally.
do go check that out, see what you can get. Rates, I mean, obviously rates have probably changed since we put that video out, but it's a good one. So do check that out. If you like this channel, hit the like button. If you like the content, I should say, don't forget to subscribe. Leave us comments below. We'd like to know what you think about the Fed's decision today and the Fed's decision to continue on. Brian, anything else you want to add?
No, just be cautious in your moves. And if you're looking for the long haul, now's a good time to step in and slowly pick up things as you see the volatility in this market continue.
All right. And also, as Brian always says, do your own research before you make any decision.
DYOR.
Always.
I need a little sign up for that. DYOR.
Right, you
I
do
gotta
like
get
a
me
little
some signs.
card.
My goal in 2023 is to get some signs, Michelle.
Do it. I love it. Let's get t-shirts. I want merch. Stop being sold merch.
Merch. You gotta have merch.
I heart Roth IRAs. That'll be the first one. Oh my goodness. All right. Well, thanks, Brian, for everything. And thanks to everyone who watched.
Thanks, everyone. Have a great day.